Hey guys, Freaky Finance here. As you can see, it's now Christmas behind me, so I always like this time of year. We start to go into companies that have performed and underperformed, and we're going to do those recaps again as we approach probably in the new year. But as we get into December, it's usually when I start putting chips on a table for 2026 and across different style factors. So Comcast is one we're going to talk about today. Different than other companies we've talked about on the channel. I'd say AT&T is probably the most common, but we haven't really expanded too much on broadband. I guess we did Rogers and Bell in Canada. So there's a lot going on in Comcast, and it's a lot of kind of, I'd say, unclear, and likely we have time for like 2 or 3 quarters, but we'll see. The price is very cheap, and it's obviously underperformed. That's why we're doing the video. Here you can see that this is year-to-date performance just to show. So Google was a great one, and just as an aside, started to look at Amazon, Microsoft, and Meta just to balance out for next year, right? To have too much of an overweight now in Google. So just basically trim and ones that I think are also great companies, right? Like Amazon. It's technically growing EPS better than the year-to-date performance, right? And it's, in my mind, better position than it was 3 years ago. Valuation's finally not extreme. And you're seeing the software collapse, which we've talked about before. I am kind of surprised the asset managers have done so poorly, aside from the one that we own, BlackRock, which would be nice if I can get that on a pullback again. But anyway, today's video is Comcast, and you can see cables got killed this year, down almost 40% for Comcast, and Charter's even worse, almost down 50. So these are almost cut in half. I mean, basically cut in half in the year so far, which is awesome. So we're doing a video partially because of that. So I like to look at losers during October, November, December. And so the core thesis, the AI here, is pretty right. It believes it's mispriced in Comcast by fixating on the headline video subscriber losses. So cable, while underappreciating the structural profitability of broadband and wireless segments, so internet and mobile, so cell phone. Cable business is in secular decline. It's no longer the primary profit engine, hasn't been for a while. High-speed internet broadband have surpassed it. And you're going to see that when we go through the numbers, that it's largely an internet company now, not cable, even though it's in the cable bucket, because that's what people think when they think Comcast, or at least a lot of the market does. Another thing, reason for the video, it also hits that you get a nice 5% dividend yield and almost a 7% buyback yield. So a material amount of money is going to shareholders. And the company, the broadband business, is high cash flow, and it's relatively stable. So it's almost kind of like, in my mind, a cheaper version of a utility, which the AI kind of hints at. But anyway, that's kind of the crux of it. Basically, it's dirt cheap, mispriced as just a cable company, even though there's a resilient high-speed broadband and wireless. And we're going to talk about the strategy today and why I think the price is where it is. But you can see, again, timing of the video, on a 1 year, down 37%, on the 5 year, down 48%. That's bad. So people who have been in it for a while are probably frustrated selling, right? There's not a lot of losers to sell, I don't think. There's not too many losers, I guess, on the year. So I think that's part of the pressure as well. But you can see we're back down at 2014 levels in the business as far as superior to what it was then. If you want, maybe I'll jump forward to the financials really quick here. We'll just go annual, and you can just see what the business was putting up in 2014. You can see only $68 billion in revenue and only $22, $23 billion in EBITDA. And now it puts out about almost $10 billion in EBITDA a quarter, right, to $123 billion in revenue. The revenue growth has stagnated. And we're going to go into that as well. That's another reason as the revenue growth slows down, the multiple comes in. We've seen that with growth companies. You also see it in value companies. The revenue growth rate always matters. So decels matter and accelerations matter. So the rate of change really matters. Anyway, another thing you'll see while we're here, you can just see the share count go basically also a lot less shares outstanding. So I'm just looking at the share price on the chart. You can see there used to be 5.2 million shares outstanding. Now there's only 3.9. It's even less on the latest quarter, but you get the gist. The business is superior to what it was back then. Here is probably one of the more interesting reasons why I think we're getting the price we're getting. And it's also a reason I agree with, so it makes this decision to buy difficult. I should say before we jump into that I do own this one. Not a big position, just a small one, down 3% in it, and basically just slowly thinking about adding or as we go into the new year. Just because it is a kind of like, in my mind, one of more defensive, boring plays, right? The EBITDA is pretty stable. The cash flow is pretty stable. The dividend's pretty stable. And if they have extra cash flow, it goes to buybacks, right? And the debt's technically better than it was 5 years ago too, right? So if the balance sheet, to worry about the balance sheet now, I mean, the balance sheet was worse 5 years ago, right? The valuation was way higher then. So anyway, I mean, there's other things I'm looking at like Duolingo and stuff, and some Chinese companies, and Melly looks a little bit interesting now. It's pulled back a bit. I've owned this on and off a few times. And there's interesting ones like Coherent, but that shut up 8% on Friday. I was going to start doing a video and it just ran away from me. And then Modine Manufacturing. We can talk about data center infrastructure at some point and the second derivatives of that. But these companies are like the opposite spectrum in terms of Comcast. Comcast is boring, defensive, stable cash flow, and potentially a melting ice cube because of the cable business. And then you have these companies, Coherent and Modine, which are basically data center proxies. So as data center, we know the CapEx is booming with Google. The people that actually have to execute on these things, Coherent and Modine, are two that look kind of interesting, but they're not value. They're totally different. They're growth, right? They're priced to grow. On the other hand, Comcast is priced to die, right? it's at 5 times earnings for a reason, or 6 times earnings for a reason, whatever your expectations are. Anyway, one of the reasons why I think we're getting the price that we're getting is that they're seeing higher utilization and new packaging, including everyday pricing and retention, helping transition more of a base into simplified market-based plans. And we continue to accelerate our wireless net additions this quarter to a record high. Now, this doesn't, anyone who doesn't follow the company doesn't understand what this means, but basically they're giving free wireless lines to people that are using Comcast to basically make it stickier. So they're going to both be a Comcast customer and a wireless customer. And that costs money to do. And the company's eating it right now and is trying to reduce its churn. And it's also investing in the relationship with the customer in the future. And then it's likely going to raise prices after this promotional period's over. Anyway, what we've seen this time and time again, the reason why we're getting the price we're getting is that they just mentioned we're going to do this investment over the next several quarters. So you're going to see margin compression just like we did in the latest quarter for the next at least 2 quarters, right? So I think this is one of the reasons why we get time, because you're going to have these comps and you're just going to see margins declining, revenue growth stagnating because they're not charging for the services and margins coming in. And investors don't want to be investors. They want to be there for the upside of the investment, right? So that's why I'm like, oh, probably still early if they're doing this. And to be fair, they have been adding a lot of wireless users, but I mean, it's free or at a steeply discounted price. And we've seen the deceleration in ARPU growth. And they expect ARPU growth to slow again. Now, one of the things that's been happening is users have fallen off. They've been charging more, and it's been offsetting it. And they expect ARPU pressure to continue in 2026. So again, we're in a place where they're in investment mode, and investors don't want to invest. They literally just want to be on the upside of the investment. We've seen this in other companies throughout since the life of the channel 5 years ago. Anyway, here's the 5-year price guarantee, and 5 Wireless strongly resembles a recent move by Charter and Spectrum, executing a pivot towards convergence. Broadband subscribers declined 104K in the quarter, which is not good. Why no price hikes? Rating hikes is a competitive market. It leads to churn. By offering 5-year price guarantees and everyday pricing, they're prioritizing stabilization and voluntary churn. And basically, they're willing to sacrifice a median price hike to keep customers from switching to competitors. Why free lines? By giving the customer a free mobile line, the customer becomes converged, and they're less likely to cancel this service. So they become more stickier. Short-term pain, and this is what we just talked about, and then allegedly long-term gain, which we won't see until, at least halfway through 26, based on their commentary. And so the stock has gone down with that, right? It's gone down 40% already, even though the cash flow is currently about the same as it was last year, and the EPS is around the same. And that's because investors don't want to be investors. What else is kind of interesting in terms of the CapEx peak? These are some of the good things that I like about Comcast, is we've already gone through an elevated CapEx cycle, right? So DOCSIS 4.0 was basically an easy way to upgrade the infrastructure to compete with the fiber built to homes. They just had to basically upgrade at certain points in their infrastructure, and it was a lot more CapEx favorable than what AT&T's and other broadband providers have had to build out. That's more expensive. So they're basically able to do that. And we also have the Epic Universe in Orlando, and we haven't even talked about the whole other side of the business, Universal and NBC and stuff like that. So anyway, they just finally opened, so we should see CapEx start normalizing, which should help free cash flow as well, I think. And you can see the CapEx intensely going from about 8.7 to 10. Free cash flow is held in there pretty good, around 13 billion. And you can see a lot of it's going to dividends, 5 billion now, because they keep raising it every year. And then share buybacks, pretty high. And you can see the debt's gone down from 103 to 92, so about 10% less debt as well in the time period, which is nice. So it's not over levered or anything. It looks like a lot of debt on the balance sheet, but the cash flow's there to support it. It's like someone making 100K a year and getting a 250K mortgage. It's kind of just napkin math. Here just to see the business. So people view content and experiences often because they see it often, right? You have Sky, NBC Universal, you have all the studios that Comcast owns, and you have also the parks. You can see in terms of the business, though, it's only 36% of revenue, or it was in 2024, and only 17% of adjusted EBITDA. And what that tells you is that connectivity platforms, so the broadband, what they charge for internet, makes them materially more money in terms of both cash flow and profitability. You can see that this is what people should be focused on, but unfortunately they're focused on this, as well as cable and the studio advertising and stuff like that from their TV shows, the linear TV shows. And you can see this is in 24, they did grow. Now we've kind of seen it level off, and that's why we're seeing the multiple come in like we have. Here you can see Versant. So this is, they're going to basically spin off that shrinking ice cube, so the cable division. And that's going to be happening pretty quick here. So I wanted to get this video out. Another reason why we're doing the video, because I want to be listening on December 5th what they're going to say when they spin out this company. I kind of want to know how much debt is being moved to this new company, the shrinking ice cube. And I also want to see their projections of the future without the company. Is the revenue growth? They should, because one is basically they're basically spinning off the undesirable assets, I think. Now, as a holder, you're going to own both if you own it now, because it's going to spin off to you. But it'll be very interesting to learn more information about it and how the RemainCo will look after this little spin-off. But you can see in terms of the revenue, it's not very big, and it's not a high margin business like it is broadband. You can see in terms of connectivity is largely residential. However, they have done well in business services, so I should give them credit there. And you can see there's a little bit of advertising, a little bit of video, but residential and business services, more than 50%. Here, just to show the footprint and where they operate, you can see pretty spread out among the more denser areas in the states. So California, Florida, and this northern eastern seaboard, as well as a little bit of the heartland. So relatively spread out, pretty big network, I'd say. In terms of the AI, when I was basically writing through the business segments and asking it questions, the cable TV economics, basically COGS are high, some margins are low. In Q3, the latest quarter, Comcast lost 257,000 video customers. Management is managing for cash flow, meaning they are raising prices to offset subscriber losses and refusing to subsidize unprofitable customers for cable TV. In terms of broadband, we're seeing a slightly different strategy. You can see the COGS is extremely low. Once the network's built, the marginal cost of delivering extra data is negligible. No programming fees paid to third parties, unlike cable, where you have to actually pay Disney or Fox or Paramount, who's ever providing the content. Anyway, margin is extremely high for broadband, and we see that with the EBITDA margins, right? And one of the things, basically, what's been happening, Comcast has been driven, it's basically growing by expanding its footprint, 90 new subscribers, volume growth. However, with the broadband penetration reaching saturation in the U.S. and housing mobility being very low, company has pivoted to yield growth, maximizing the ARPU, so basically charging more per user. It also has a rental economics business, so the XFI gateway does also generate higher margin recurring revenue, but also helps people basically increase the stickiness, increase the switching costs if they also have rented equipment from you. And this is the one thing I think is special with Comcast, is that unlike fiber competitors who must trench new lines to every home, which is capital intensive and slow, and sometimes the economics don't make sense, Comcast utilizes its existing hybrid fiber coaxial HFC plant. So by upgrading the amplifiers and nodes within the networks, Comcast can deliver basically better speeds over the existing network that already enters the home. So it's like a mid-split technology upgrade that allows Comcast to compete on speed claims without the prohibitive capex that the other providers are currently undertaking. And this capital efficiency frees up free cash flows, one of the reasons why the dividend is relatively safe and the buybacks have been quite high lately. The cash flow's been there because they haven't had to go hard into capex. By bundling the mobile line with a broadband subscription, Comcast creates a sticky ecosystem where the customer is financially penalized for leaving. The convergence flywheel, so data indicates that broadband's customers who subscribe to Xfinity Mobile have significantly lower churn rates. The buy one get one free promotions act as an aggressive customer acquisition tool, subsidized by the higher margin of the broadband product. In terms of the business segment, they also have done I'd say better than other companies in business. Comcast is constantly bidding for large distributed enterprises, so retail chains and large bank branches that require connectivity across hundreds of locations. By leveraging the vast footprint, Comcast can undercut legacy telecom carriers. Technically, the business service connectivity was the most profitable division in the entire corporation in terms of EBITDA. So they make a lot of money in terms of profitability per dollar generated with the business services connectivity. In terms of content and experiences, so the one that most people think about, you can see theme parks is only 18% of revenue, but it's 39% of adjusted EBITDA. So theme parks, well, they're not a huge driver of revenue, they are a huge driver of profitability. So they're the highest margin product in this segment. You can see media is a large part of it, but it's only 42% of adjusted EBITDA. The studios, relatively same trend. They do own 42 NBC and Telemundo local broadcast TV stations, right? We have Peacock in here as well, which we haven't talked about. And those investment losses are finally getting better. So you have both headwinds and tailwinds with this investment. So it's definitely an interesting time to look at it. But anyway, and then you have the parks, Universal and Universal Epic specifically lately. We won't really go into Sky or anything like that today just to save time because it's already going to be a long video. Anyway, here you can see just the park looks like, and most people are familiar with the offerings, right? With the parks and the Epic's now open. Peacock is also finally, I'd say, getting more scale. Losses have pulled back. There was like a big arms race, I'd say, between Disney and Paramount and HBO and Peacock and Amazon. And basically we've seen, I'd say, a little bit of pullback, a little bit more prudent management. They've also been slowly raising prices because these things were so much big losses for all the companies. Losses have finally peaked. I think it was more than $1 billion in losses. Yeah, they still had an adjusted EBITDA loss in 2024 of $1.8 billion, right? But it's $1 billion better than 2023 was. So it's a money-losing segment, the Peacock business still, but it's finally approaching break even. This is the spinoff, so you can see the spinoff is going to get a bunch of like MSNBC, CNBC, but you can see a lot of the core brands are still going to stay with Universal. So it has your news and sports though, and your entertainment and digital. And we'll see kind of how they split this out, how this balance sheet is going to look like, how this balance sheet could look like, how does the growth rate look after these things are peeled off the shrinking ice cube. Anyway, and that's going to be on December 4th. So I will be paying attention then to get more information, and I wanted this video out on today's date, which is November 29th, 2025. Just because I think it'll be interesting. Normally, if you want, you can freeze frame here, but they have a nice schedule. All the big telcos and broadband providers do this. They have these nice quarterly things, and you can kind of see the trend over time and see how stable it is, like 81 billion in connectivity, basically doing 20 billion a year or a quarter in revenue, right? Which is nice and steady. And you can see that total content experience is about 10, sometimes slightly more volatile. And then in terms of the EBITDA, which is more important than revenue, you can see connectivity and platforms, basically 8 billion a quarter. And you can see it's very stable, kind of boring, utility-like. However, the reason why we're starting to see a sale is because the margin on its core business is coming down because they're basically giving free wireless lines to try to reduce churn and keep more people on their broadband network. So this is the reason why we're getting the deal, and it's also because management said they're going to expect more of that for the next 2 quarters at least. That's why I think we probably have time on this idea, but it's definitely interesting to look at. Anyway, you can see there's more volatility in things like the theme parks, which are starting to, I'd say, increase, partially because of Universal Epic. You can see here the ARPU, so the trend over time, you can see it was growing, and then all of a sudden it's declining, and that's when we started to see the correction in the stock. So as soon as the broadband net adds, its bread and butter, started feeling pressure, basically it's like, oh, maybe our prices are too high, and now you're seeing, oh, but now we have to give free things to keep them from leaving, right? It's not a great position to be in. However, you can see the wireless lines are now going from 2.8 to 7.8, right? So still low penetration, only 10%, but it does give them an opportunity to basically give people wireless lines and try to keep them paying for their broadband services. And you can see the ARPU that they've taken a decent amount of price over the last 5 years, going from $62.50 average revenue per user to now $74.20. It has been able to raise prices despite competition in the past. This is one of the things I thought was interesting on Disney's call. They basically asked like, hey, with the new Universal Park, how's your business in Florida? And they talked about Epic in the past, in particular, something we knew was going to be a factor in domestic parks, and in fact is much in line with our expectations. Fine. But if anything, it seems to be, in fact, impacting the rest of the competition down in Florida more than it's impacting us. And we've seen that, like, look at Six Flags stocks, right? Cedar Fair and Six Flags, when they merged, they're seeing pressure in attendance. And basically, this is kind of hinting like, oh, we're still fine, but we're seeing pressure in other parks that aren't us, which I thought was interesting. What else can I say? The latest quarter, similar trend. I kind of talked about how it was weaker in terms of margin, and you're seeing that here play out. Now, the EPS doesn't look as bad on the decline. on the quarterly because they've bought back so many shares. So a lot of the EPS decline from this current investment is being offset by the share buyback. Here, the cash flow you can see in the 9 months, 24 billion, 25 billion generated. Only 8 has to go back in the business, right? And you can see they're paying a decent amount of dividends, 4 billion, and repurchased 5.6. So you can kind of see what's happening. Then you're seeing, I'd say, a slow repayment of debt over time as well. A nice thing about now, like if there was no headwind, like what they said with we're going to invest and give free lines and see margin compress for another 2 quarters, this would be a great time to look at the company because we finally have the CapEx behind us for the parks. And we should start seeing scale in Epic, and the higher per cap spending is also going to be nice. And they said it's lifting the attendance across the entirety of Universal Orlando. So it's going to lift the attendance in the other parks as well, or that's what they're hoping. And one of the things AI did quite well, it was like, I was like, explain the strategy. And it basically said people usually think Universal is like an add-on to their Disneyland holiday. So they might go 4 days at Disneyland, 2 days at Universal, or 2 and 2 or something like that. And what Universal's trying to do here is take the whole week. So we have enough parks so you can stay with us and our parks for 4 days and basically get that more of that whole chain. And that's the strategy here. And we'll see if it works. It is an interesting strategy. It's a higher margin area. So if they can get more growth here, especially as they peel back the ice cube, as they spin it off, it'll be very interesting to see. In terms of the leverage we already talked about, still going down. It used to be 2.4. Now it's 2.3, and the dividends have been slowly going up because they're slowly raising it. And the share buybacks have been relatively high, I'd say, over the last 3 years. Especially for a business that's now has less than $100 billion in market cap, right? When you're generating $10 billion in EBITDA a quarter, you get a lot of juice. You can offset a lot of EPS declines from your core business suffering in this investment phase. And now that the market's probably like, is this truly going to be a 2-quarter thing? And then what happens after? Are you going to be able to raise price, and are you going to see a lot of churn still? So maybe, we'll see what happens. Maybe they're targeting specific people that are more likely to churn with free lines. I don't know, but it'll be interesting to see. And this is kind of how they're thinking. This is why it's like the fact that we've set up 4,000 is a real opportunity, 400,000, not just in terms of relationship that will continue to build, but also an opportunity financially down the road as they convert. So basically convert to being paid. So this is kind of, again, the strategy just worded in their more professional way, whereas I like to just call things as they are. Here you can see, again, this is the mobile growth, right? It is growing quite well, but a part of that is because they're trying to secure, so when they raise prices again, people don't leave. So they're basically giving away free lines, bundling the mobile and broadband together, and it is reducing churn. Now, like the other stats said, about 10% of their penetration in terms of the strategy, now it's 14%. So you can see this as a strategy, and it is going to start eating into EBITDA growth for the next at least 6 months. In terms of who owns it, I was kind of surprised. There's a lot of people who own it at a high rank, so maybe that's why, and they've owned it for quite some time with material losses, right? When it's only at $26 now. Almost everybody in the top list, average price materially higher because it hasn't been this cheap for since a decade ago, right? Exception here is one person that has a 3% position, very small. Anyway, you can see there's a decent amount of people that have a high ranking to this loser, so there's some conviction here that this is temporary. I'd be interested to see who's selling in Q4, given what they just said, like 2 more quarters of pain, and who's going to add as this thing either trades sideways or maybe it goes up. Valuation is not a catalyst, so usually you need to wait until the investment period's over and see if it's actually true for this to work. Kind of like a wait and see for now, and kind of it'll be very interesting. Maybe they have a huge forecast, like what they think Comcast will look at in 2028 without the shrinking ice cube after they spin it off, and maybe that drives the share price in the short term. We'll see. That's kind of what I'm thinking, is they paint a very rosy picture of the RemainCo without their spin-off properties. But we'll see what they say on December 4th, right? I have a feeling that's going to give me a lot more information that whether to make this it sounds like a decent idea. I just need to know if it's going to be a great idea. And I think the next quarter will help me to get more information. But yeah, that's Comcast. It's definitely an interesting business, right? A lot of people just think about the Universal Parks and the studios because they see them all the time. But it's a lot more than that, right? And the Peacock losses are finally starting to get closer to break even, which is also nice in terms of a rate of change. So there are things like the themes park and Peacock, our rate of change is positive. Then you have this investment period on the broadband, which is negative. Then you have a spinoff, which we're unsure about. So there's a lot of things going on right now at this specific time, but I wanted to get the video out ahead of time. So anyway, I'd like to know your thoughts on Comcast. If you have any interesting companies that you think would be interesting to look at as we approach the end of 2025, I'm always interested to see where some opportunities lie. Anyway, I'd like to know your thoughts and have a great rest of your week.